Hey guys, so in this lesson we're going to be looking at candlestick formations, candlestick reversals, and candlestick charts, all of that. So what are candlesticks? You guys might be familiar with candlesticks themselves. You might already know what candlesticks are, candlestick charts, but you're probably familiar with line charts, line graphs, where you plot a line with data points, right? You can look at charts that way as well. You can look at price action just with a line chart. You can also look at bar charts, and there's other candlesticks as well, such as, Heikin-ashi, I think I'm pronouncing that correctly, which is another candlestick type of setup, or candlestick type of chart, not a setup. But we're going to be focusing on candlesticks. That's how I look at the charts themselves. I look at them via candlesticks, not bars, not lines, okay? And there's a reason for that. Line charts, they just give you one point of reference, such as the high, the low, the close, or the open for that day, whichever one you choose to set up your line chart based on. The candlestick itself, a candlestick will tell you all of those data points within that one day, or month, or week, or 4 hour, or 1 hour candle, so it will tell you exactly the high, the low, the close, and the open for that specific candle, for that specific time frame, whichever time frame it is that you're looking at. So they're very useful, and there's so much data packed within one candlestick, which makes them very powerful. So what we're going to be focusing on are the reversal candlesticks themselves. We're going to be focusing on patterns later, but right now we'll be looking at reversal candlesticks. So what are reversal candlesticks? Reversal candlesticks are pretty much candles that tell us that the market is going to reverse from either a bullish run, reverse and go lower, or the opposite, bearish run and reverse and go back up. So reversal candlesticks pretty much tell us that one specific level, the horizontal support and resistance, or some kind of support and resistance, is going to be rejected because of that specific candlestick, what that data is presenting for us. So that's what we're going to be looking at. Now, history of candlesticks. Where did they originate? So the theory is that they were originated back in Japan. They were created by a rice trader back in the 1800s. And then they came to North America, to the Western world, by a guy called Steve Nissen, if I'm correct. I believe I'm correct. Steve Nissen. And he wrote a book on candlestick formations. And that was back in the 1970s, 1980s, somewhere around there. And since then, candlesticks are some of the most popular ways to analyze data. And that's exactly why I use it too, And the one thing to really say is that there's many different candlestick reversal setups out there. If you look at online and you Google candlestick reversals, you're going to see hundreds. If you look at the guy, Steve Nissen, and his data based on, or his candlesticks, his book on candlesticks and what he wrote about them, he's going to have hundreds of different candlestick formations, and to me that is too much. I don't look at that many because I like to simplify my trading. Guess what? A candlestick is not the only thing that I look at when I make my analysis. It's what gives me the data for that specific day, or that daily chart, that monthly chart, that weekly chart. But I look at various things. I look at horizontal support and resistance levels. I look at some of the indicators like the 50 EMA. I look at price action analysis, price action patterns, multi-time frame analysis, and I combine it all together into strategy. So a candlestick formation is an important part of that, but it's just one part of my analysis. So I focus on the main candlestick reversal setups, and I have a group of, I believe, 5 or so that I look at. And we're going to have a look at all of them when we jump on the charts right now. So let's have a look. All right, guys, so again, we have the same chart layout as in the previous lessons, and we're going to be focusing here again on the British pound against the dollar. Same chart, we're familiar with it. We've already analyzed this chart, so let's just continue with that analysis. Let's have a look at this monthly chart. All right, and we're going to talk about candlestick reversals, okay? What are candlesticks? Well, candlesticks is something. It's an analysis tool, okay? So candlesticks is an analysis tool that was initially originated in Japan back in the 1800s. Okay, it was used to trade rice. okay, measure the price of rice back then. So it hasn't really come from Japan till the late 1900s. I think it was like the 1980s or 1970s when it was firstly introduced in here in the Western world. But it has been a concept that has been used for a very, very, very long time. And now it's the main tool used to calculate price. Now there are many different ways that one can calculate price, So if we just click on this, so charting types, there's candles, okay? There are bars, which looks kind of like that, a little bit weird. But some people are going to prefer bars. To me, I find that they're a little bit harder to read. And I'll show you how to read them. There's obviously, you can use histograms, but it's not going to be very relevant in the way we trade. There's a line. So also, you can use that, but it's also not going to give us as much detail as required. Okay, a line is great to kind of map out an overall price, but it doesn't have the detail of a candlestick. And I'll show you what that detail is in a second. There's obviously an area. You see this a lot as well. That's something that can be used to just graph the overall price of the market. And then there are other different candlestick types as well. But the ones that we're going to focus on is just a simple candlestick. Okay, that's what we want to look at. Now, when it comes to these candlesticks, I use hollow candles, meaning that, my candles are empty, meaning that bullish candles are empty. But you're going to have people who are going to have a green candle instead. It's not going to be hollow, it's going to be green. I just find that it kind of looks a little bit weird. I traded with green candles almost from many, many years, But then when I flipped it to simple white and made a hollow, I just like the looks of this better. I find that it's much cleaner, and I want my charts to be clean. So I use white for the bullish candlestick, and it's a hollow candle, It can be full if you want, but I like the look of the hollow. And I obviously use red for the down candle. You need one to be full, otherwise it looks weird. So this is how I have it set up. I have a full-bodied red candle for the bearish candlestick, and I have a hollow-bodied white candle for the bullish candlestick. Something that's like I said, the most common is you're gonna have a green candle for the bullish candle, and it's not gonna be hollowed. It's gonna look like that. To me, it looks ugly. I traded that way for many years, but like I said, after switching to hollow and white for that bullish candle, it just cleaned up the charts for me. So I just visually prefer it. There's no advantage in any way. It's just visually more appealing to me. That is it. That's the only reason why I use hollow candlesticks, because I know people are going to ask. That is the only reason. Just visually appealing. Now, what is a candlestick? Okay, so a candlestick gives you much more data than a typical line chart, So what kind of data does it give me? Within one candle, and we're going to just jump back in time, just to this candle right here. And within this one candle right here, okay, this last candlestick, okay, it's called a candlestick. What that gives us, it gives us a few different points. It gives us the open price, it gives us the close price, it gives us the extreme high and extreme low, okay? That's something a line chart does not give us. A line chart only gives us 1 point, which is either going to be the extreme high, the extreme low, the close price, or open price. So if we go, I'll show you that just so you know what I'm talking about. So if we go to a line chart, and then you can source either close, open, high, whatever. You cannot have all of it. Okay, you can have one or the other. Okay, but you cannot have all of that data. The candlestick will give you all of that data. It will give you the high, the low, the close, and open. Okay, which is what we need. We need that. Okay, to properly trade the way I trade. Okay, you will need that. So, how does a candlestick work? Okay, so let's focus on this bearish move here. So we get a bearish move. Okay, price is going down and down and down and down, and you can see, this day has closed right here. And it has opened at the exact same price. Then it closed a little bit lower and opened at the exact same price as the previous close. Went lower, closed right here, and opened at the exact same price as the previous close. Okay, went down, closed right there, and opened a little bit lower. So why did it open lower? The reason being is this was a weekend, or actually we had a gap, and it gapped down. Typically, a gap means that the market was closed. Either it was a weekend. If in the stock market, you look at the stock market, it gaps every single day. That's because pre-market data, okay, or post-market data. So when the market is closed, there's still trading going on. You can still trade it even when the market is closed. So sometimes when it comes to FX, it mainly gaps over the weekend. And this is a small gap, okay, like this, where again, the close price from the previous candle does not match the open price of the new candle. That means the market has gapped. So when it comes to FX, that gap typically happens over the weekend because the market is closed on Saturday, Sunday, right? And if there's a significant news announcement over the weekend, then we will typically see a gap in price. It doesn't happen too often though. So when you look at the daily chart here, you're gonna see that. That's why I like to trade FX market, because it's very easy to read. There's almost zero gaps here. I can't find many gaps in the market, Whereas if you look at the price of, let's say, let's pick a random stock. Let's say Apple. Okay. But there it is. You can see that Apple gaps quite a bit. That's because, again, the market closes daily. Equities market closes daily, So here, the New York session is only open for the New York session, not for the Asian, not for the European session, just the New York session. So if there's any news announcements after the session, the market will gap, such as right here. That was an earnings gap. We had earnings that day. Earnings are typically once the New York session closes, and the earnings will be released typically within 2 hours of the market close. So then the market gapped before it opened, So when it opened again, it opened right there. That's a gap in the market, okay? And we will talk more about that when we actually start digging into the equities and add on to MasterClass. But for now, for these purposes, let's just focus on what we're going to be seeing most, which is going to be FX for now. And in the FX market, you just know it doesn't gap too often. It might just gap over the weekend. All right, so let's just wait for these charts to load again, and then we'll continue. There we go. So let's jump back to the monthly chart again, because we're familiar with it. And let's talk about this candlestick one more time, right? So we're talking right here. Closes, opens, right? So now this is a bearish move, meaning every single candle is bearish, meaning that it closes lower than the open price, right? So opens right here, closes lower than the open price. Same thing here. Opens right there, closes lower than the open price. Let's have a look at a bigger candle. So it gapped a little bit here, but it opened at this price and it closed lower, okay, than the open price. So it gives you a bearish candle. Simple, right? Now, close price, open price, and it closes higher than the open price. So it gives you a bullish candle, right? Now again, opens right here, closes lower, gives you a bearish candle, a red candle. Opens, closes higher, gives you a bullish candle, okay? So that's the difference. Now, what about these weird little sticks that come up? That's called the wick, okay? So imagine you have a candle, and then you have the wick of the candle, okay? Imagine like a real world candle. That's what it is actually based on. That's kind of how it looks like. So the wicks, that's the extremes in price that day. Okay, so when you're looking at this candle right here, okay, so this big one. So this candle closed at this price, opened at this price. Then during that day, this is a monthly chart. So during this month, okay, price action went up. So the lower price action, the intraday price action in this case, or the weekly, daily price action in this case, price went up, gave us a high during that month, went down during that month all the way down to here, gave us this lower wick, so that's the extreme low. and then ended up closing the month right here. Okay, the body will only be between open and close. That's where you will get the body, between the open price and the close price. That is the body of the candle. Okay, the wick will be the extremes, will be on either end, either to the upside or to the downside will be the wick. Okay, so like in this case, price went up, it opened, price went up, and it could have closed right here. If it closed right there, it would have been a bullish candle, but it did not. It tested the 20 EMA, so we have the rejection of the 20 EMA here. The wick has rejected. When we're talking about rejections, we're typically going to be looking at these wicks. The wicks are rejecting levels, okay? Like right here, the wicks are rejecting the 20 EMA. Important, okay? So we have another rejection right here. So during that day, or during that month, in this case, this is a monthly chart. So during that month, the wick has rejected, the price has rejected the 20 EMA and went down to close massively lower than where it opened, okay? So that's the wicks. So let's fast forward a little bit. We got some bullish candles here. And then come down to here. Okay, so price action is decelerating here. We have a whole deceleration lesson coming up. We just focus on the candlestick for now. So right here, price, this was a bullish candle, so price closed right here, opened right there, most likely went up during that month to reject the 50 EMA, and then ended up closing bearish. This is a bearish reversal candlestick, okay? We have many reversal candlesticks. So there's candlesticks that are just kind of random, okay? In between price action, in between the runs, I mean, you know, between the lows and the high in price overall in the market, okay? This is a run. And this is something, again, we're going to cover in the next lesson. But for now, let's focus on the candlestick itself. So this is a reversal candlestick. What this would be called, this is called a shooting star. Now, I don't know where that name came from. It's kind of weird, the shooting star. We have some weird terminology when it comes to the candlesticks. So I call them a different way. You know, I learned from Infinite Prosperity, and when I learned with different terminology. So I call this a high test. Makes more sense, right, than a shooting star. But anyway, some of you guys are going to know it as a shooting star. Some of you guys are going to know it as a high test. And what does that mean? Well, we have a high. Okay, so a high test. It tested the waters over here. It tested this 50 EMA. It tested the extreme highs, and then it closed lower than the open price. Okay, so because it closed lower, this is a bearish. Okay, a bearish high test reversal. That's it. Right here. See this candle? Very similar to this, right? But it's the opposite. It's a low test. Or in the terms that some of you guys might know it as, it might be referred as a hammer. Because I guess it looks like a hammer, right? Makes a little bit more sense. So this is a hammer. You got the body of the hammer, you got the handle of the hammer, okay? Or a low test, okay? I'm typically gonna refer it as a low test reversal. A bullish low test reversal means price opened right here, okay? Tested the lows, okay? And then closed bullish. A bullish low test reversal. Makes a little bit more sense than just an imaginary hammer, okay? But both terms are correct. It's either going to be a hammer or a low test, okay? So that's we saw two candlesticks here, okay? So this is, again, a hammer reversal, okay? You can write that down. Take a screenshot, pause, take a screenshot, take notes, okay? Draw it out if you need to, take a lot of notes. But this is a hammer or a low test, okay? The one that we looked at prior to this was the same type of candle, but the reverse, okay, which was this one right here. Okay, let me jump to it. And this is a high test or a shooting star. Okay, so some of you guys might know it as a shooting star. I don't know where it's shooting from or where the name came from, but a high test makes a little bit more sense to me, you know, so I call it a high test. It means that it tested during that month, and then it closed bearish. So this is a bearish high test reversal or a shooting star. Okay. Now, that's not the only reversal candlesticks that you need to be familiar with. There are many more. Okay, so let's talk about a few more. Such as this candle right here. This is called an inside bar. A bearish inside bar reversal. And the way this looks, it means that we have this big bullish candle. Okay, so big bullish candle, and then the body of this candle fits within the body of this big bullish candle, meaning it's an inside bar. Okay, it fits inside this big bullish candle. It makes sense, right? So to me, this terminology makes sense. You might hear it as a different name, but to me, this will be an inside bar reversal. It fits inside this big bar. Okay, so bearish inside bar reversal. So what does this mean? It means that price action did not want to go any higher that day or this month. Instead, it rejected the 50 EMA and closed lower. Okay, so giving you this inside bar reversal. And then you can stack confluence factors. It doesn't mean that it's always going to reject, but then here, let me do it this way. Okay, now you have this another candle, and then another candle, a bearish high test. So now it's decelerating. We have an inside bar. This can be called a high test if you want, but we have this inside bar and then another bearish high test reversal. So bearish inside bar, bearish high test. This is good deceleration. Okay, now you start adding confluence factors. So this is called a reversal candlestick setup because price action is rejecting this 50 EMA, and this is a reversal candlestick, meaning that it tested that 50 EMA, it failed, so that bulls were testing this 50 EMA, and then the bearish price action took over, the bears took over. There was much more selling in the market that month, right? So many more selling positions that month, which ended up giving us this bearish candle, closing lower than where it opened. So giving us this reversal, this high test. So the bulls tested the highs that month, and then the bears won. This is where you always see that terminology, the bull versus the bear. Okay, so the bulls were fighting to the upside. They tested that 50 EMA, and the bears won the fight, if you want to refer it to that way, meaning that it ended up closing the month lower with this bearish high test reversal. So I think that makes sense. Okay, so we have this inside bar and a bearish high test. What else do we have? If we look at this candle right here, so we looked at a bearish inside bar, and this right here, when the chart loads, this is a bullish inside bar. Okay, so bullish inside bar. That's it. Meaning we have this big bearish candle, and then this candle right here, the next candle, fits within the body of the previous candle. And if you have the candle that fits within the body of the previous candle, this is called a bullish inside bar. Okay, so it has to close higher than where it opened, because we were in this bearish trend. So we're looking for reversal setups, So in order for price to reverse, well, it has to reject and close higher, right? So that's exactly what it's doing here. This is a bullish inside bar. Okay, so take a note of it, screenshot it, write it down. Now you already have a few candles that you should be familiar with. I hope you're taking notes. So there's a few more to take a note of, and I'm going to show you this weekly chart instead. At the end of it all, I'll show you how it all fits together. But this weekly chart, so what do we have here? We have another reversal candlestick, one that we did not cover yet. By the way, I'm just going to show you the candlesticks that I use most in my analysis. The rest will not matter. So if there's other candlesticks, to me, they just don't matter. Okay, but there are many different candlestick patterns that you can look at. Now, what we have here is a bearish engulfing. Okay, so this is a bearish engulfing reversal. Why is it a bearish engulfing? Because it fully engulfs the previous candle. It is much larger than the previous candle. It means that it opens at the same price. So this candle closed right here. It opens and then it engulfs the entire candle. This is a very strong reversal candlestick pattern. Extremely strong. This is one of my favorites, okay? Because it's so powerful. So this is a beautiful bearish engulfing reversal. Okay. Now, what happens right after that? Price action falls. That's what it's supposed to. Okay. Let's jump to the weekly time from here. And see, price action falls. So that's what reversal candlesticks are supposed to tell you. They're supposed to tell you that, okay, we have a rejection of this level. So price action rejected a level here. It gave us this massive bearish engulfing, and price went down from there. Okay, what else can we get? So here's another example of an inside bar. We looked at inside bars. Here is another example of that inside bar. But one that we did not cover yet, it's a doji, which is another very popular candlestick formation. And that is the doji. So here we have a few dojis. Okay, price went down and it's going down and down and down. And then all of a sudden it's slowing down. Okay, and then we have this tiny little candle. Okay, where it barely goes up, it barely goes down. The open price is almost the same as the close price. So we don't have a big body like in these candles. Price opened here, closed all the way down there. A doji, this is a doji. Both of these candles are dojis. Means that they're very small, the wicks are very small, the bodies are extremely small, and that's a doji. It means that, what does it mean? Well, when a doji happens at the bottom of a bearish move, okay, it means the same thing. The market is slowing down. There is not much bearish pressure. The bears are not active during this time. But same are the bulls. The bulls are also not active during that time. So the market is kind of neutral. Means that there's something there. There's most likely a horizontal level or some kind of level that price action is rejecting. Okay, so it's giving you this pause in the market. That's all it is. A doji is pretty much a pause in the market, and most often than not, it will give us a reversal to the upside. Most often, it will give us a follow-up, such as this, a bullish engulfing, which is going to be a much stronger reversal than a doji. So you're going to notice that I like dojis, but I will also most often look for a follow-up reversal, like a low test or this big bullish engulfing, like in this case. Okay, so that's another candle that you need to take a note of, and that's a doji. And a doji is a doji. It can happen at the bottom of price action or at the top of price action. A doji is a doji. Another ones. Let's look at some more that we can look at. But these are the main ones, so we looked at bullish engulfings, bearish engulfings, we looked at inside bars, a bullish inside bar, a bearish inside bar, and we looked at the high test reversal and a low test reversal. Okay, now one powerful candlestick is a tweezer top or a tweezer bottom reversal. Okay, a tweezer top or a tweezer bottom will always start off with a high test or a low test. Okay, that will always be the first candle. Okay, so here we have a beautiful high test reversal. Means again, we tested the highs, the bulls tested the highs, and then the candle closed bearish. So it's a bearish high test or a shooting star. This is again a shooting star. So some of you guys might notice that. The next candle after that is the same thing. Right? We have another high test or another shooting star. So combine them together, this will give me a tweezer top reversal. I guess it kind of looks like a tweezer, like actual tweezers. But that's the basis of it. Two high test reversals at the same time gives you a very powerful short selling signal. So whenever I see something like this, to me, that is awesome. That is great, and price is supposed to go down from there. And eventually this, sometimes it will consolidate or decelerate like this, and here we get another bearish engulfing, and then price goes down, But that is the basis of it. You're going to have combinations of reversal candlesticks as well, such as right here. What do we have here? We have an inside bar, because this candle fits within this big bullish candle. So we have an inside bar, we have a doji, and then we have this massive high test, bearish high test reversal, right? So when you have multiple candlesticks in one, that is great. That means it's decelerating and rejecting a specific level. Okay, let's look at more of that, more combinations. Right here, okay, we have a double doji. So we saw a doji before, that was at the bottom of the bearish market. This is a doji at the top, okay? So double doji, they're both dojis, followed by a big bearish engulfing, okay? Very strong reversal pattern, okay? Means that the dojis are showing us that there's not much bullish action, there's not much bearish action, so it means that there's something there, you know, there's something being rejected. And then finally we have this big bearish engulfing to confirm the rejection. This is a beautiful setup, okay? So candlesticks, combine them together and it gives you a beautiful candlestick reversal pattern, okay? But the ones that we covered, those are pretty much the major ones that I will use, okay? That you will see me talk about, such as the high test, the low test, so the shooting star or the hammer, you know. Then you have the doji, you have the inside bars, and you have the engulfing candles. Those are the major ones, okay? You don't need to, when it comes to my trading, you don't need to know anything else, you know? Those are the main ones. So review this lesson many times, take a note of it, you know, screenshot, do your analysis, even do it by yourself, look at a different chart and try to find these candlesticks, okay? The high test, the shooting stars, the low test, the hammers, okay? The dojis, the inside bars, the bullish engulfings, right? Everything that you need to know has been explained in this lesson when it comes to the candlestick. What is a candlestick? And the major candlestick reversals that I look at, okay? And then the combinations is when you combine the reversals together. And the most powerful combination was that tweezer top reversal pattern that I showed you, okay? That's a very powerful one, is the tweezer top, okay? Now let's put it together. How do you utilize them? Okay. Well, you utilize them when you put it all together. Okay. So we know this analysis here. We looked at it multiple times already in the previous lessons. Okay. So we have the monthly chart here on pound dollar. So you want to look for reversal candlesticks when price action hits a rejection, rejects a support and resistance area. Okay, so this is a support and resistance area. We got the daily or the monthly 50 EMA, the moving average. We got a horizontal support and resistance, which is major. It's a very good horizontal level. And we got the Fibonacci retracement. All of that is very powerful, okay? And with that said, so price action is rejecting this level, but how do we know it's rejecting it? It's because it's giving us these reversal candlesticks, okay? So price action is stalling at this resistance by giving us this bearish inside bar. Then another random candle and a big bearish shooting star or a high test reversal. When we see reversal candlesticks at support and resistance levels, that is where you want to focus your attention at. Not at these random candles here. You want to focus your attention at the resistance areas, okay? And then look for reversal candlesticks. And once you get a reversal candlestick, then that is where your entry is. Okay? This is just a random entry, but that is what you'll be focusing on. So that is it for this lesson, guys. That's the lesson on candlestick reversals. Watch it multiple times. I showed you the major candlestick reversals that I focus on myself. You will hear many other candlestick reversals that I might mention here and there throughout this training. But these are the major ones. These are the most common reversals. So again, simplicity is key, guys. And that is it for this lesson. I'll see you guys in the next one.